with all the uncertainty in the market, we can see the fear and greed index is sitting at 26. So we're definitely in a period of fear. So a lot of people are transitioning to defensive ETFs and stocks. One of which is going to be SCHD, which is known for its low expense ratio and high dividend growth. Very consistent. But there's actually two ETFs that I prefer better and has been blowing SCHD out of the water. But first, let's go over SCHD, exactly what it is and why it's been so popular. So SCHD, the goal of it is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index. It's going to be a straightforward, low-cost fund offering potential tax efficiency. And this fund can serve as part of the core or it can complement your diversified portfolio. And it tracks an index which is focused on quality and sustainability of dividends. Now, if you're subscribed to this channel, a lot of you love dividends, especially high yields, and are not satisfied with SCHD in particular, mainly because we're only getting about a 4% dividend yield annually. It pays out quarterly, and especially in the past 4 years, you're not really seeing anything in terms of share price appreciation. So a lot of people have been seeking out higher income, and you can achieve that with covered call ETFs, getting much higher dividend yields as well as possibly some share price appreciation as well. And the most notable thing is going to be those frequent payouts, either monthly or even weekly. So SCHD being quarterly has not been very attractive to a lot of investors, but it still has its place. It invests in a lot of defensive companies. We can take a look at the top holdings. You're going to see a lot of very defensive companies such as AbbVie, Amgen. You have Lockheed Martin Corporation, PepsiCo, Coca-Cola, Chevron, Home Depot. So you're not seeing growth stocks, or you're not seeing any volatility or speculative companies either, which is very good for people who want something that's a little bit more stable in their portfolio. But something to note is this ETF has not been doing well in the past 4 years, and if you had placed that money into a high yield savings account or a certificate of deposit instead, you would have outperformed SHD in the past 3 or 4 so years, which is kind of crazy to think about. Now, the ETF we want to go over is going to be DIVO, which is the Amplify CWP Enhanced Dividend Income ETF. It has a 5-star Morningstar rating, which means it's proven, it has a good track record, and it's outperforming SHD by quite a big margin. Now, the ETFs on this list, they're not going to utilize options, and they are only going to be monthly payers, but you are going to have decent income potential as well as share price growth as well. So why would you invest in DIVO? Well, of course, the income potential. It is comprised of high quality dividend oriented stocks along with covered calls on individual stocks. So even though it does covered calls, the main focus is going to be high quality dividend oriented stocks. We're also going to seek to lower volatility. Dividend and option income is going to provide lower share price volatility versus the overall market during times of broad-based market declines. So now is the perfect time to invest in some of these defensive ETFs. We've seen fear in the market. We know that a lot of these tech-focused stocks have dropped quite a bit, which in turn is going to make a lot of other ETFs, such as ULTY, Pay, even Velmex, Option Income Strategy ETF, it's going to be down quite a bit because there is a lot of risk involved with these ETFs. So a lot of people are transitioning right now to some defensive holdings. SHD is a big contender, but DIVO has been doing well as well. We can see DIVO is going to be up in the past year 7.80%. So it does have good share price appreciation, and it has a higher dividend yield than SCHD, as well as a monthly payout frequency. So you're getting 3 things that are better than SCHD in terms of share price, dividend yield, and payout frequency. And those 3 things combined has earned a 5-star rating from Morningstar. Now, one thing we want to note is it does have a higher total expense ratio of 0.56, but when we take a look at the total returns later, we can see it's completely justified. It does cover calls to have a higher premium income, and in return, we're going to have a higher total return than SCHD, even though SCHD's expense ratio is quite low at 0.06%. Now we can see the yield is going to be between 4 and 5%, pays out every single month, and we can see the distributions from 2025 have been quite consistent. You can see it's been between 16 and 17 cents per share. And this is really good for people who want something a little bit more defensive. They don't want to do something extremely high yield, high risk. They want something where it's reliable, it's consistent, and DIVO has been doing that. You can easily see that it's had consistent payouts, and this is good if you want to estimate your bills, pay off expenses. A lot of people are using these dividends not only to reinvest, but to pay off their expenses. If we take a look at the top holdings, we do have some exposure to top tech companies such as Apple and Microsoft, but we also have some very defensive companies like Raytheon, American Express, Home Depot, and Goldman Sachs mixed in here. So it's going to be a good selection, and we can actually see their selection methodology down below. You're going to have dividend growers. It's going to place a strong emphasis on owning high quality large cap companies with historical dividend and earnings growth. You're also going to have sector allocation. It's going to be balanced among the traditional 10 S&P 500 sectors. And then CWP is going to determine whether sectors to over or underweight based on various market factors. And then, of course, you're going to have security selection. So it's going to consist of 20 to 25 stocks, which are screened aggressively and adjusted according to attributes, including market cap, management track record, earnings, cash flow, and return on equity. And that is the main difference between amplified ETFs versus SCHD. You're going to have active management. They're going to aggressively screen the companies versus SCHD. It's going to have an annual reconstitution, but you have to wait a full year for portfolio changes to take place. And that can have a big impact on your returns because they can't act immediately on this. And it's a passively managed ETF. And then, of course, we have tactical covered call writing. Covered call options are written on individual stocks on a tactical basis. So they're not going to aggressively write covered calls. Every now and then, they are going to write a covered call, and that is going to help bring in some additional income. Now, a 4 to 5% annualized return is nothing crazy. We're not seeing anything competing with, say, Roundhill ETFs or Yield Max, but they are doing it in a strategic way. They know their audience. It's going to be for people who are a little bit worried. They want something stable, and this could be a good complement to a high yield portfolio. Now, if we take a look at the total returns, SCHD versus DIVO, we can see year-to-date return, SCHD is only up 1.63%, a very pathetic return in my opinion, but we can also see that DIVO is up 14.65% year-to-date. That is a crazy return, and it's blowing SCHD out of the water. Now, if we take a look at the total returns since 2016 of December, SCHD does have a better total return of 148%, but DIVO is beating SCHD by about 40%, coming in at 183% total return in about 9 years. So we can clearly see we have better growth, monthly payouts, as well as good share price appreciation. DIVO is a better choice, in my opinion, than SCHD, but they both have their places. SCHD may be a little bit more stable in terms of share price, but in the long run, you're not going to have a better total return. Now, the second ETF that is going to beat SCHD is actually a Fidelity ETF, the Fidelity High Dividend ETF FDVV. Now, even though this ETF pays out quarterly and has a lower dividend yield of about 3%, it does beat SCHD in terms of total return. We also have an expense ratio of 0.16%, so it is quite low, even though it's a little bit higher than SCHD, but comparing the total returns with dividends reinvested, that is going to make a huge difference. So we take a look at the all-time since 2017 or 2016, it has a share price growth of 123.82%, a very respectable share price growth. And then if we take a look at the top holdings, we can see we are having about a fourth of the sector allocation to the technologies, but we also have 21% to financials, consumer staples, and utilities, and energy being the next top sectors. So that growth is going to come from technology. We can see there's 6% to Nvidia, we have Apple and Microsoft as the top three holdings, but then we also have those defensive companies, JP Morgan, Broadcom, Visa, we have ExxonMobil and Bank of America, as well as Coca-Cola. So a very similar strategy to DIVO, mixing in some good growth companies that pay dividends, as well as some defensive companies for those market downturns. And these are really great options for market uncertainties, which is a good period we're in right now, according to the Fear and Greed Index. And if we take a look at the fund page, we can see the objective is going to provide investment returns that correspond to the performance of the Fidelity High Dividend Index. And the strategy is going to be it's investing at least 80% of assets inside of the High Dividend Index, as well as it may lend out securities to earn income for the fund. Now, even though 3% is a very quote-unquote low yield, it's still a respectable yield. It pays out quarterly. I know a lot of people are not a huge fan of the quarterly payouts, but total return-wise, it's done pretty well. And the index it's referring to is designed to reflect the performance of the stocks of large, mid-cap dividend-paying companies that are expected to continue to pay and grow their dividends. So all three of these ETFs, SCHD, DIVO, FDVV, have a very similar strategy. They want dividend growers. Now, which ones do it the best? FDVV and DIVO have done it quite well. And we can see it also has a 5-star Morningstar rating. So this is also a proven ETF. It has had great returns. We can see the hypothetical growth of $10,000 since 2016 to 2025. You would have tripled your money almost. And in fact, let's put it into our total real returns calculator and compare it to both SCHD and DIVO. So we can see it has a year-to-date return very similar to DIVO at 14.49%. Now, if we scroll down and compare it for the total return since 2016, we can see it has a total return of 191.41%, which is actually on par with DIVO, and it blows out SHD out of the water. Now, SHD may be the most popular option on this list, but we also have to consider that there's other products out there, other ETFs, that may provide a better return if you're looking for that dividend growing ETF. And in my opinion, these are some of the best ETFs to invest in when we are in market uncertainty. The economy is pretty rough. The job market's not doing great. Inflation is quite high. The dollar is down 9% on the year. I think we need to start going into some more defensive ETFs. Let me know down in the comments down below. Do you have any shares of SCHD? Are you invested in DIVO? Or are you considering FDVV? Or is your strategy just pure high yield income? You want to invest in the YieldMax ETFs? You want TY, or you want the Roundhill ETFs? Do you want WPay? These are all great options. In the next video, we're going to go over the top 3 weekly paying high yield dividend ETFs for people who are looking for that weekly income.